Most major mutual insurance companies out there have just declared their dividend for the year, and they have all declared their best ever. Right? If you're wondering why, right, what the dividend is and why everyone's declaring it their best ever, stick around because that's what we're going to discuss today.
Welcome to the Infinite Wealth Podcast, where we teach clients how to build wealth and create passive income without the risk of Wall Street.
Welcome to the Infinite Wealth Podcast. I'm Cameron Christensen, along with our co-host Anthony Faso. And if you guys have ever wondered what is a dividend, and if you guys have ever wondered why every major mutual insurance company out there has just declared their best ever dividend, stick around because that's what we're going to be talking about today. Anthony, let's get started. What do you think?
Let's do it.
Awesome. So let's start with what affects a dividend.
Well, one of the first things is mortality, meaning how were the actual death benefits paid to what they had budgeted. And then the next piece is expenses, right? Are they running as efficiently as they had budgeted? And then probably the most important piece is going to be investment performance, right? Out of the investments that they made, are they higher than what they had budgeted as well? But there's also another one that's, I think, is very important as well.
You're right. There is one last point that we'll add here, and it's going to be the cash reserves. Every large major mutual company that is out there sits on large amounts of capital. One of the reasons that they do this is because they are required to. They are state regulated, and the states require that these companies keep large amounts of capital on hand. You know, God forbid there's any sort of large scale disaster where they're able to pay out. Maybe some poor underwriting, right, in any given year for whatever reason. These reserves allow a company to kind of withstand any of the ups and downs from the investment side and or those mortality expenses. And the companies do have some leeway, right, as far as how much they can keep on hand versus how much they pay out. So they do have a little bit of discretion there. The last thing we'll say on that part of it is you guys need to remember these policies are over-engineered.
What do you mean?
Yeah, one of the best analogies that I've heard to explain this goes all the way back when I was looking at whole life insurance and buying some for myself. Was the analogy that I was given is that whole life insurance policies are like a bridge, right? Bridges are built to scale. They're built to hold a certain tonnage per pound. And so they're never going to build a bridge that is going to just meet exactly what they need. Mm-hmm. It is going to be a multiple of what they expect is going to be the maximum threshold or force that's going to be put on that building. And so it can absolutely withstand kind of what gets thrown at it. And that's exactly what is happening with these insurance policies is they are very conservative on some of their expectations or projections on expenses, on the mortality and the investment side. So they are overbuilt, right? There's always going to be a contingency fund that they can make up in any given year if needed.
Awesome.
Yeah.
Well, Cameron, you started with the great news that all these insurance companies are paying largest dividend ever.
Yeah.
But you kind of seem like that wasn't that big of a deal.
It's not, right? It's again, a lot of what you see out there is going to be marketing, right? It's like that 3-letter word behind a CPA's name. It's not all it's cracked up to be. The best ever declaration of dividends. You have to remember what's going on, right? In the last couple of years, in 2020, there was some legislation that went through that allowed the insurance companies to change kind of the guaranteed and their non-guaranteed rates. And so really what they've been able to do is shift some of the money from the guaranteed side, lower the guarantees, and shift it a little bit over to the non-guaranteed side. So I would fully expect that most everybody's going to have one of their best dividend declarations ever, right? And that's what you're seeing.
You know, and I think that this also goes like what Nelson had talked about. There's a difference between rate and volume.
Yeah.
Right. We're going to talk about the rates by the companies. And to be honest, I mean, I'm going to let the cat out of the bag. The rates were pretty much the same. Right. So the dividend rates were the same, but the company's bigger because they got more premiums. Mm-hmm. So at the same, of course, it's going to be larger on the dollar amount.
Yeah.
Right. And so I think, and we're going to get it. The dividends are all sizzle to me. Yeah. Which I know we're going to get into a little bit more, but that's my take.
Yeah. Right. Let's cover a couple of these dividend rates, right, that are being declared. You want to do that?
Yeah. I kind of already let the cat out of the bag.
Yeah.
But, you know, again, for us, it's not about the insurance company.
Yeah.
Right. We work with a lot of insurance companies. They're all great and they all have their niche and who and what they're best for. But a couple of the dividend rates, we have 5.75, 6%, 5%, 5.65, 5.8, 5.2.
There's an NA on that sheet too. You see that?
Yeah.
Yeah. I was going to ask why, right? Why is there an NA, right? Meaning a company did not declare their dividend.
Well, in fact, with this company, this company is One American. We actually had interviewed one of the higher ups.
Yeah.
Right. And he said the reason why they don't is because dividends are very misleading and they're misunderstood and misused. And the reason being is there's a lot more that goes into the policy than the dividend. The dividend is just a small piece of the puzzle.
We have been intentional in not assigning kind of the names to some of these dividend rates, right? Again, is because we don't want to highlight one company that touts their dividend, right? And in fact, you need to run the illustrations, right? You need to look at how a policy is going to perform moving forward. And so you can have a company that declares a lower dividend than one other company, but the illustration actually is a little bit better, right? So again, it's very misleading on some of the dividend rates, right?
What I thought was the most interesting thing here, the company that pounds a table on how great their dividends are the lowest that we had looked at, right? So, so for the most part, all of these companies, the dividends, they had maintained the same rate as they did in the prior year. Cameron, is that what you had expected or hoped?
I'm always hoping to get the most for my money. So I hope that my companies, right, that I have policies with are paying the most. But I did expect the dividend rate to increase because of the redesigned policies from the last year or two, right? As companies have been able to shift a little bit more money over to the non-guaranteed side. So it is going to look better when they declare that dividend.
For me, again, it depends what lens we're looking at this. You know, as a policy holder, I want more cash.
Yeah.
I want to put that cash to work. And with the rising interest rates that really shot up this year. So part of me was expecting I was hoping that there'd be a higher dividend. But to be honest, with my expectation, that was more of my lens as owner. Because remember, we only work with mutual companies, so they're mutually owned by the policyholders. If I was I am the owner, but if I was the guy calling the shots, that'd be great. Interest rates shot up, but not really until the middle of the year, and it takes a while for that to show up on their income statement. But also, man, there's a lot of unknowns going on. A lot of people are expecting and calling a recession, and some are saying it could be a real bad recession. So I would want to be conservative, and I'd want to hold on to the cash reserves in anticipation with what happened next. So even though I was hoping for higher, I'm glad that they were prudent and that they had maintained the dividend.
Yeah. Anthony, what would you say is kind of the takeaway here?
Well, what I would say is how important are dividends, right? And to me, dividends are sizzle. They're just a small piece of a very large puzzle. And to me, the dividends are distracting, because I even know there's a couple IBC people out there that are pounding all of these dividend rates. Man, there's so much more that goes into it. And, this reminds me of a story, right? Cameron.
Oh boy. Oh gosh.
No, it's not about you.
Okay.
No. But as you know, I did a triathlon. Now, singular. I only did one, and I did like a baby one. I did like the Cameron size triathlon. So it really isn't anything to brag about. But what that did do is that got me into cycling for a period of time.
Okay.
And with cycling, man, they're very focused on the weight of the bike. Right. And there was a friend of mine who was bragging that he spent $500 on these new pedals, and those new pedals were going to shave an entire pound off of his bike.
Dang. Okay. All right.
But I started thinking, what if you took that $500?
Bought a motor?
Well, no. What if you paid for coaching and you worked on you being able to ride the bike better and you work on your technique? That will not only pay dividends currently, but when you get a new bike, or you can take that on for the rest of your life. And I think that's the same thing with dividends. We get so focused on these dividend rates and how the policy is performing. Let's take that time and focus on how we can use this policy. What are some things that we can do with this cash value? Whatever the dividend is, it is. But let's learn how we can use that cash value to create that passive income more than your monthly expenses.
And I couldn't agree more, unfortunately, right? Dividends are a complete distraction. We've touched on this before, right? There's going to be a lot of this marketing that's going to be going on at the end of this year and even early next year, where they're going to be touting the dividend rate. But again, it's very misleading. Again, some companies are declaring their dividend rate prior to expenses. Some companies are declaring a dividend after their expenses. So it is not a fair comparison overall. So again, we're going to set that aside, and we need to look at the overall piece of the pie. We're going to look at policies, how we're going to use them, what investments we're going to make, and then we got to be good stewards and make sure we get those policies, loans paid back. So hope you guys enjoyed this video. Don't get distracted by those marketing material out there talking about how great dividends are.
And go make it a fantastic day.
Take care.
Thanks for listening, and be sure to subscribe so you don't miss out on the next episode. Also, check out our website, infinitewealthconsultants.com, to find our podcast along with other additional resources.